Deal valuations are producing high expectations for sellers across industries. This may not necessarily be a new trend, but be it tax reform leading to greater profitability or just an immense level of dry powder on the sidelines that is driving the demand for deals, one thing is certain: the deal-making process is transforming. I'm Tom Terrarosa with The Deal. Here with me today to discuss this transformation are Pepper Hamilton partner Joe Kadlec and Pine Hill Group Business Valuation Manager Curtis Farrow. Thanks for joining us today, guys.
Thanks for having us.
So tell me, Joe, at a high level, what's going on in the deal-making universe that's in regards to price and valuation?
Sure. So I think you teed it up pretty well. This is not a new trend. There's a lot of dry powder. Debt is cheap. There's a lot of competition out there, and that's somewhat new. There are, for buyers, there's family offices are getting into the space. Bigger funds are moving down space to look at the mid-market where I generally work. There's co-investors, people are fundless sponsors and bringing on other equity and whatnot. So there's a lot of competition, but it's not new. So I'd say what's going on right now is that people are starting to realize these high prices are the new normal.
Okay. So how might high expectations be changing how deals get done and then the implications for acquirers thereafter?
So it used to be the story that sellers, it was a big question whether sellers and buyers' expectations could align. They're starting to do that, and people are realizing it is what it is at this point. So in a competitive process, what it has led to, buyers are trying to look for ways to maybe bridge the gap. If they can't reach the price that they want, but they know the seller's expecting it. In the last few years, we've seen them try to bridge that gap through things like rep and warranty insurance. So a buyer and seller would buy an insurance policy to cover their reps and warranties in an agreement. This is relatively new. It's picking up a lot of steam over the last few years. But in a competitive process, you're seeing it in almost every deal at this point. The speed of the deals has moved up. When I first started, 60, 90, 120 days was the typical exclusivity period. Now we're getting pushed down to 30 all the time. There's a rollover component. If you're a private equity fund, you generally want to have, depends, but management may want to roll over, the PE fund may want them to roll over to incentivize them going forward. So in the past few years, people are looking for ways to bridge that gap in valuation expectations.
Okay. And so as these trends become more commonplace as you're describing, I mean, do the deal drivers change again, or what becomes the evaluation?
Right. These things were trends and unique ways to distinguish yourself. They're not anymore. Mm-hmm. Now they're becoming they're prerequisites for a deal in a competitive process. So it has seemed recently that we're back to the same world where price drives everything. Which is, depending on which side you're on, depending on which bidder you are, that could be good or bad. So I think right now we're kind of back to price driving a lot of things, but sellers still have a lot of leverage, and so they're using that to push for other things as well.
And when they have that strong leverage, what does it mean for the deal teams?
The speed can move up even more. So I mentioned 30 days. Nowadays, if someone tells me we've got 30 days to do a deal, that sounds like plenty of time. Mm-hmm. It's funny how that's changed. The expectations on how much work is getting done prior to exclusivity has changed. It might be the expectation that there's just no more diligence to be done once a bid's has gotten to a point of signing a letter of intent. We're off to the races, no more diligence to be done. And so, there's a lot more work in the earlier stages that affects the lawyers. We have to prioritize our diligence, be efficient, focus on the things that are actually deal drivers and not confirmatory points. Those will come later. The deal teams on the business side are doing the same. They're focusing on what's really going to drive this deal, what's really driving the price, and the confirmatory points will come after. But there's also been a trend, though, as people understand the price. It is what it is. People are getting used to all of these other factors in deals that I mentioned earlier. They're getting pushed to another level. So, for example, it's a fairly more recent trend, I think, but as in a competitive process, and again, I want to clarify it, if it's not a competitive process, a lot of what I'm saying goes out the window. Okay. But in a competitive process, sellers are, they might be expecting a public company style deal, even if they're a private company. Mm-hmm. And what that means is, it could be rep and warranty insurance like I talked about before, but there's no deductible that the sellers have to bear. The buyer's on the hook for every penny. sellers may they may say that even taxes, that is something we don't want to be on the hook for. You can do your diligence and figure out what the liability is. A known liability issue, which used to be, and still sometimes is, how are we going to handle this known issue? Is there a line item indemnity in the deal where a seller is going to be on the hook for some known risk? That's somewhat going by the wayside. There may be an escrow account for that, but that would be the extent of liability. Because it's important to remember in that type of item, rep and warranty insurance only covers the unknown. So if a buyer knows about something, they're not going to be able to get insurance for it. So a lot of those things are driving. And what has been very interesting for the lawyers, and I think a lot of clients sometimes like this, people are cutting to the chase more so. So if it's, and what I mean by that, if it's a competitive process, we're trying to do this quickly, more and more buyers are serving up a more middle of the road, maybe even a seller-friendly draft of a purchase agreement. And we're just getting to the point where we're really cutting to the chase and getting the deal done.
Okay, so we're talking about all these things that all this change that the sellers are driving in the deal making space. But for buyers, what can they still rely on in terms of deal making?
Well, speed can be good for the buyers too, right? There's certainly risk for the sell side of a deal dragging on too long. There can be risk on the buy side too. So it's good to move that forward, and they can rely on that. But most importantly, I think, even with rep and warranty insurance, even with the speed that deals are happening, the diligence still needs to be done. Even there may be an insurance policy backing everything up, but it has a cap. You don't want to be buying an asset where you only are protected for 10% of the purchase price or 20%. So you still have to do your diligence. As I mentioned, known issues are not going to be covered by insurance. So if that affects the purchase price, if it's just for your planning purposes, you need to be ready for it. And then really the last point, higher price is going to affect your modeling. I think the deal community certainly understands that, probably more than the lawyers, of course, but that goes into the modeling and where the exit's headed down the road.
Okay, so speaking of the price and the modeling, I mean, when you're talking about you paid this price and you figured out what you actually got, Curtis, can you walk us through a little bit about what happens after the close? The buyers should be aware of in regards to really ironing out those details of the valuation.
Yeah, absolutely. I mean, there's a whole whirlwind of things that happen as soon as the close happens. That's really not the end, it's the beginning of the new. And one of the important things that happens during that process is what's called a purchase price allocation, which is partly a valuation exercise, but also partly an accounting exercise. And what happens during that is the opening balance sheet of the new company is created. And as part of that, it's a multi-step process that happens in that first you have to determine the purchase consideration, and then you have to allocate that consideration to the various assets that are acquired.
Okay, so when you're speaking of purchase consideration, is that where the rollover equity and things like earn-outs come into play?
Yeah, I mean, the purchase consideration is very straightforward if it's an all-cash deal, right? There's really no valuation to be had there, but in a lot of deals we see, and especially as Joe was referring to earlier, with private equity firms in a platform deal, often they want the sellers to stay on and they want them to be incentivized to drive future value. So that's where rollover consideration often comes into play. And it's important in the negotiation process ahead of a close that everyone is well aligned with what that consideration on the rollover equity is. We've seen a lot of issues when we have to go in there and value what did the sellers actually get when there's multiple classes of stock. And that's a very common thing with private equity deals. Often the private equity company is getting preferred stock in the business where on a sale, on the exit, they get their money back and often a return on that money by way of an accrued dividend or some other kind of preference before anyone else gets to participate. So the headline price on a deal isn't necessarily the per share value that the sellers are going to get. And there's nothing wrong with that. It's a way for the buyer to mitigate some of its risk. But it's important that that's communicated up front so that you're really doing what your intent is with the rollover equity, which is to incentivize management, not have them asking a bunch of questions and have them thinking they received more than what they truly did, because that will be fleshed out in this exercise.
Okay.
One of the other things you often see in purchase consideration that's a little different and has to be accounted for separately is earnouts or contingent consideration. So a portion of the total headline price is carved out and will be received upon the achievement of different milestones. Maybe it's revenue growth, maybe it's something tied to EBITDA, or a combination of things. And often buyers and sellers, for that matter, go in with an expectation of what's really that true value. Is this a really high hurdle that, yeah, if they get it, great. If they hit the home run, so to speak. Other times it's really baked in where it's kind of the opposite. Unless things really go south, they're going to hit that. But in the accounting exercise, the world of certainty is hard to swallow for auditors. So usually it's not an all or nothing. It's somewhere in between that full value of what the potential consideration is. And that gets hammered out in the valuation process that unfolds.
Okay. So speaking of uncertainty and private equity and private company deals, there's been a discussion surrounding PCC election. Can you explain when that comes into the conversation?
Yeah. So first and foremost, that really only comes into play with private company acquirers. It doesn't apply to the public companies. PCC stands for Private Company Council, and it's an election that came out a couple of years ago, but often still has a lot of confusion around when do you use it, when is it really not advantageous to do it, and what is it all about. So the Private Company Council came out with this election for private businesses in an effort to save them some of the reporting costs that go along with the transactions, and namely what it allows is them to not recognize certain intangible assets separate from goodwill in that purchase price allocation. So to backtrack, the purchase consideration is determined. Now we're allocating that value to the various assets that were acquired, the building that came along, the equipment, and then all the intangible assets, things like a customer relationship, a non-compete agreement, technology, and a myriad of other things. And the Private Company Council says, okay, customer relationships and non-competes in certain situations do not need to be separately valued. The determination as to whether or not it makes sense for you largely is a factor of what you think your exit is going to be. If you see down the road an exit to a strategic buyer that happens to be public, or a large private company whose bank has covenants that require GAAP-based financials, it's not going to make sense for you. You'll save a tiny little bit now and pay a lot more on the back end when you have to go and unwind all of the work that's been done over that holding period and really just do the full valuation to begin with. That said, if the acquiring company, if their bank also requires GAAP-based financials, if the exit is in the form of an IPO, again, you become public, and it just doesn't make sense. The other important issue within there is different accounting firms look at that election a little differently. So while the intent was for these companies to save a little bit of money in the exercise, a lot of times the audit firms, for their valuation teams, they really need those assets valued anyway, because as part of the purchase price allocation, the way you assess the reasonableness of the answers you come up with is through a weighted average return method. So each asset has a different return that's applied to it. Goodwill being the most risky, things like working capital being the least risky. And in order to have that proper balance, you have to really understand what the delineation of the true assets are, whether or not they end up on your opening balance sheet or not.
Okay. And so I'm sure you play a big role in this. When do these companies have to decide when to decide on going through all this and figuring out when they have to value things?
Yeah, so for the public company acquirers, they, as you might guess, don't have the luxury of time. They're on the quarterly system, and their auditors are going to be expecting at least adjustments in their next Q, or not adjustments, but estimates rather, in their next Q. And oftentimes those estimates are really the final number. So they don't have a lot of time. Private businesses oftentimes have a little bit more time on their hands if they want. We always recommend not to wait, especially towards year end. So if you close the deal in June, get it done in the summer months. That tends to be when audit teams and valuation firms are a little slower in their workload, and that gives them a lot more time to just knock it out and get it done. More importantly, everything is still fresh and the documents are there, and it just makes the whole process a lot smoother and takes away from the interruption of the normal business activities.
Thanks so much, guys. It's been really insightful. Thanks for coming.
Thank you.
Thanks for having us.